We can see a collaboration in place between various market players aimed at dealing with the current shocks that the economy is facing, and understanding that these are short-term shocks, and equally, more importantly, an understanding that various institutions want to work again with their various borrowers to ensure that the Kenyan citizen or the shock to the Kenyan citizen is as minimal as possible, because ultimately we do believe this is a short-term problem that we are addressing and that will be brought back to line. And that is why I'm saying we are appreciative of some of the measures that are being taken by the banks to ensure that ordinary Kenyans are shielded from the shocks of this short-term problem.
The KBA, having consulted with the Central Bank of Kenya and the government of Kenya, have taken some measures, the 5 measures that the minister alluded to, which are as follows. The first measure was to extend the loan repayment period for the borrowers. This will ensure that the borrowers can still be able to meet their borrowing obligations at the levels at which they were meeting before the recent interest rate increases. Secondly, the banks have agreed to capping the maximum interest in the loan repayment amount to a maximum of 20% in consultation with the borrowers. This means that the installment will then be spread out, leading to an extension of the repayment period. This is essentially a combination of spreading the repayment amounts and an extension of the repayment period to fit into the required installment repayment by the borrower. Thirdly, the absorption of the costs by the banks. Since the interest rate adjustments may precipitate loan defaults, banks will absorb some of the additional costs from changes in the macroeconomic environment to the maximum extent possible without threatening their viability. This really entails sacrificing a portion of their budgeted profit margin. These measures and the one immediately below are hinged on the premise that while short-term interest rates will increase, lending rates are also driven by other factors. These factors include opportunities for investment, and overpricing loans may kill avenues for investment. The fourth measure is that banks will not raise their interest rates despite the recent further increase in the central bank rate by the 1.5%. You'll recall that on Thursday, 1st December 2001, the Monetary Policy Committee met and adjusted the central bank rate upwards by 150 basis points to 18%. Banks will absorb this increase and mitigate the additional burden on existing borrowers. But this will only apply to the existing borrowers. The interest rates for new loans will, however, not be accommodated within this measure. And finally, the fifth measure that the banks have taken is to remove any penalty on early repayment of loans, where the banks have decided where in case the banks, or rather in case the borrowers decide to prepay or repay the loan before the contractual due date, the banks will not levy any penalty despite the contractual terms in the agreement. And all these measures have been taken by the association in view of the fact that we are sensitive to the plight of Kenyans and are supportive of the government policy for the national goals.
And if we were all to be able to work in collaboration together, I believe that we can overcome this particular situation and restore normalcy both in the financial markets and in the overall economy. And that is why we will continue as a government to encourage market players to be able to work together as partners so that we can overcome this and get back again on our growth trajectory, again aimed at improving the lives of ordinary Kenyans.